Hey everybody, welcome back to MacTax. We are here at the official office instead of the home office today, going over the One Big Beautiful Bill, most comprehensive video I'm going to put out. I got a 45-page executive summary printed out from Checkpoint, from Thomson Reuters. That's our tax research software that we use. I'm going to be going through as briefly but detailed as possible what I think is most important here. I'm going to highlight all of the tax changes from the new One Big Beautiful Bill outlined here that was passed on July 4th, 2025. I'm going to start with what I did not see addressed in this bill that changed, which is the 1099 DA form that is going to be issued in 2025 from all crypto exchanges like Coinbase, Gemini, Kraken, for the proceeds of your transactions. What that means for you, if you are using multiple exchanges and wallets to trade your crypto, and you're using a decentralized wallet like MetaMask or Phantom, and you're moving that to an exchange to then off-ramp it and sell it, you are going to have a 1099 DA without cost basis on there. And if you don't use a crypto tax software to reconcile and calculate your cost basis, or you leave it off your return entirely, you will be getting an automated notice. We've been seeing a ton of these CP 2000 notices that our firm has been helping clients get out from under. They're an automated notice that shows the gross proceeds with zero cost basis, and they assess a tax bill sometimes in the hundreds of thousands of dollars. This is an automated notice. This is not an audit. So 2025 is going to be the year where you got to start taking crypto seriously. And if you need help with that, please reach out to us. We can help you with that. But now let's get into the bill and the tax changes. They address nothing about crypto. So yes, crypto's taxable. That was the point of the start of that rant. Now let's get into all of the non-crypto changes starting in 2025, some starting in 2026. The standard deduction is staying mostly the same. It is increasing a little bit. It's around $30K for married couples and $15K for single individuals. That has remained mainly unchanged. The state and local, in other words, SALT deduction, is increasing from a cap of $10,000 to $40,000. It further increases to $40,400 in 2026, and an additional 1% in 2027, 2028. The act phases out SALT, which is state and local taxes. That's your income tax and property taxes for when you have adjusted gross income above $500,000. And then the act provides that the deduction will not be reduced below $10,000. So once you start making over 500K, your deduction gets less and less until it gets down to $10,000. So that is a nice area that they brought back that's going to help a lot of people in high tax states. Now they made permanent, that was supposed to go away, the estate tax exclusion. So that's when you die or you gift assets. If you're a single person, each person gets $15 million. It gets indexed for inflation each year that you can gift or pass on upon death without paying estate tax, which is roughly 40%. So if you're single, that's 15 million you can pass on to your heirs. And if you're married, that's 30 million that you can pass on without incurring estate tax. That is the total value of all assets in your estate. If it exceeds those numbers, there is a death tax or gift tax, and there is a gift or estate tax form that needs to be filed. Once you make over $250,000, $300,000, itemized deductions in general start to get limited. They changed the way that this gets limited. Now, I'm not going to get into the details because it's above what this video really entails, but they changed the deduction. They changed the way itemized deductions get limited for those that make over $250,000 if you're single and $300,000 if you're married. Let's talk about repayment cap on excess advance premium tax credits is eliminated. So this is if you get health insurance through the marketplace exchange, otherwise known as Obamacare. This is where if you enroll, you can get a advanced tax credit on the health insurance, which makes the premiums that you pay each month on the health insurance cheaper. that has to get reconciled at the end of the year on your tax return. So you can say your insurance is $1,000 a month for health insurance. You can get an advanced tax credit, so you only pay $800. But if you make more than a certain amount, this only applies to people who are making a certain amount of money. It has to get reconciled on your tax return, and you need to make sure you didn't get too much of an advanced credit and you have to pay that back. Under pre-tax law, the repayment cap limited the additional tax on applicable dollar amount for taxpayers whose household income was less than 400% of the federal poverty line. As a result, taxpayers will have to repay their excess premium tax credit in their entirety. This is taking place in 2026. So in other words, if you tell the marketplace that I'm only going to make $60,000 and they give you an advance credit of say $10,000 off $20,000 worth of health insurance premium, so you only pay $10,000 throughout 12 months for health insurance, but then you do your tax return, you really made $500,000, you're going to have to repay that full $10,000 on your tax return because you told the marketplace you're going to make less than you really did. Now, there's a lot of changes to the premium tax credit. There's going to be more that pop up in here later. So that will come up again shortly. Now, for taxpayers 65 and older, there was an additional $6,000 deduction beginning in tax years 2025 through 2028. That is the way to reduce the amount of tax on Social Security. No tax on car loan interest. The Act provides individuals, including non-itemized filers, so you need to take the standard deduction. There is a temporary tax deduction for interest paid on loans used to purchase a new personal vehicle. For tax years 2025 to 2028, individuals can deduct $10,000 of car loan interest, subject to a phase-out if your income is over $100,000 if you're single and $200,000 if you're married. To qualify, the debt must be incurred after December 31st, 2024 to purchase a new personal vehicle secured by a first lien on the vehicle for original use, so a new car. The vehicle must be a car, minivan, SUV, pickup truck, motorcycle with a gross weight less than 14,000 pounds, and final assembly must occur in the United States. The taxpayer must include the VIN number on their tax return to claim this credit. Enhancement of the Child and Dependent Care Credit. The Act increases the maximum credit to 50%, reduced by 1 percentage point, but not below 35% for each $2,000 that the taxpayer makes above $15,000. The credit is further phased down to 20% when AGI is between $75,000 to $105,000, and that's $150 to $210 for a joint return. There is now a charitable donation available up to $1,700 for donations to 501c3s that give scholarships. So a 501c3 that grants scholarships, if you donate to a 501c3 that is raising money for scholarships, up to $1,700 of that is now a deduction. That is new. So there is extended rules available for disaster relief. Even if you don't itemize, if there's a natural disaster, you're allowed to claim a casualty loss even if you do not itemize your deductions. Social Security numbers will now be required for American Opportunity and Lifetime Learning Tax Credits. Those are the education credits that are available for college classes. So going back to premium tax credits now, I'm going in order of this executive summary. Some lawful present aliens are now ineligible for the premium tax credit. Premiums attributable to individuals who aren't lawfully present in the United States aren't taken into account in computing the premium tax credit. However, under current law, premiums attributable to individuals who are lawfully present in the U.S. are taken into account. The Act amends this rule by introducing a new category called eligible aliens. Under the Act, premiums attributable to individuals who are lawfully present in the U.S. but aren't eligible aliens are not taken into account in computing PTC, premium tax credit. The Act defines eligible aliens as an alien who is lawfully present in the U.S. and who, for the entire enrollment period for which PTC is claimed, is reasonably expected to be an alien There's 3 bullet points. An alien lawfully admitted by permanent residence under Immigration and Nationality Act, green card holder. An alien who has granted the status of Cuban or Haitian entrant as defined in Section 501E, Refugee Education Assistance Act of 1980, and granted a parole as a Cuban or Haitian entrant, or an individual who lawfully resides in the U.S. in accordance with the compact-free COFA, referred to as Section 402B. Observation. These ineligible aliens include deferred action for childhood arrivals, DACA recipients, and temporary protected status holders, non-immigrant visa holders. So those people are no longer eligible for the premium tax credit. The exchange, the open marketplace, must verify applicants' eligibility to enroll in qualified health plans, receive advanced premium tax credits. Now, this is very interesting. The Act imposes a new verification on health exchanges. It provides term coverage to, won't include any individual covered by a QHP enrolled through an exchange any month beginning before the exchange verifies the individual's eligibility to enroll in the plan for premium tax credits. So you have to verify that you can get health insurance. They're going to be verifying this, and this is what I found interesting. They're going to be checking more detailed your household income, but they added what's called a failure to file and reconcile penalty. So if you did not file a return and reconcile your premium tax credits, like how I talked about earlier, you will not be eligible for premium tax credits the next year. So if I had to file a return last year to reconcile my premium tax credits and I did not do that, for the current year I will be ineligible to get that premium tax credits if I did not comply by that, or if my spouse did not comply by that. Moving along, the Act permanently suspends miscellaneous itemized deductions. Those were set to come back. Those are not coming back. The Act does expand the deduction for teachers. There's a normal deduction for school expenses, or if you are above that threshold, you can take the remainder as an itemized deduction. New tax-deferred investment accounts for children. The Act creates new tax-deferred investment for children called Trump accounts. Specifically, these accounts are eligible to receive contributions from parents, relatives, employers, and other taxable entities, as well as entities, nonprofit, and government entities. To be eligible for an account, the child must be a U.S. citizen and have a Social Security number. The Trump accounts must be invested in a diversified fund that tracks an established index use of equities and grow tax deferred. Contributions to a Trump account are limited to $5,000 of after-tax dollars. The annual contribution limit is indexed for inflation. Contributions to Trump accounts from tax-exempt entities such as private foundations are not subject to the $5,000 annual limit. Distributions. Subject to some exceptions, Trump account holders may not take distributions until age 18. Pilot program. U.S. citizens born between January 1, 2025 and December 31st, 2028 will contribute. The government will contribute $1,000 per eligible child. So if your kid was born just before 2025, they're not getting the $1,000. My kid got screwed there. The IRS will establish, so this is interesting too. If the IRS determines that an eligible individual does not have an account open for them by the first tax return where the child is claimed the qualifying child is claimed, the IRS will establish an account on the child's behalf. Parents have the option to opt out of the account. And again, this begins in 2026. The adoption credit has been expanded to $17,280 per child. Effective 2025, the adoption credit is enhanced to include a refundable portion of $5,000. Additional expenses treated as qualified higher education expenses for purposes of 529 accounts. They have expanded 529 accounts to include eligible education, tuition, materials, books, instructional materials, online education, tutoring, educational classes outside of the home, fees for nationalized testing, college admissions exams, dual enrollment, education therapies for students with disabilities. The Act increases the annual limit for 529 distributions from $10,000 to $20,000 for K through 12 expenses. The Act also provides qualified post-secondary credentialing expenses are eligible for 529 distributions, like trade schools and certifications, like that. There is now added a charitable deduction floor, 0.5% of AGI floor. So like for medical, you can't deduct your expenses until they exceed 7.5% of your income. So if you make $100,000, you can't write off medical expenses until you have spent more than $7,500. So if I spend $7,501 on medical expenses, I can deduct $1 of medical expenses on my itemized deductions. The charity donation is now 0.5% of AGI. You cannot deduct charity if you're itemizing until you donate more than 0.5% of your income, and that's starting in 2026. Premium tax credit disallowed for aliens below poverty line who are ineligible for Medicaid. As a result of this change, lawfully present aliens with income below the applicable poverty line will no longer be eligible for premium tax credit, even if the alien can't receive Medicaid coverage. So there is now also a permanent non-itemized charitable deduction for individuals. The Act provides that non-itemized taxpayers may claim a charitable deduction not in excess of $1,000 or $2,000 for a joint return. So you definitely want to be giving your accountant your charity for this year, even if you're not itemizing. That will begin in 2026. You want to start giving that. Excise tax on certain remittance transfers. The Act establishes a 1% tax on any remittance transfer to be paid by the sender, collected by the remittance transfer, provided to be remitted quarterly to the Secretary of State. An exception from this imposition of excise tax is available for the remittance transfer withdrawn from a financial institution with a U.S. debit or credit card. This does not apply to virtual currency, nor does it apply to businesses. So this is if you are sending money overseas to family, that is now subject to a 1% tax. You want to check like Western Union, Wise to see the implementation of this 1% excise tax. Limitation on wagering losses, gambling. The Act used to be, the rule was you could deduct gambling losses up to gambling winnings. So if you won $50,000 and you lost $50,000, you can take an itemized deduction of $50,000 gambling losses. The Act instead imposes a 90% limitation. This is super unfavorable. So you could win $100,000 in gambling and lose $200,000 of gambling. That means you can only deduct $90,000 of losses. So even though you lost more money than you won during the year, but since you won $100,000 in gambling, you can only write off $90,000 of losses. So even though you lost that money, you're still picking up $10,000 of income. Gambling is a super inefficient way tax-wise to make money, and it's highly discouraged under this new law. And especially with all these platforms giving 1099s, unless you're getting it in the casino with chips, even the casinos are giving out more W-2Gs. I would try and avoid it as best possible. It's not going to be pretty when it comes to your taxes. The moving deduction has been permanently eliminated. It was temporarily eliminated. It's now permanently eliminated, but they did allow an exception for military, and they added intelligence community to those who are eligible for the moving deduction. Those are specific to military intelligence community members. Bonus depreciation is back, otherwise known as 100% expensing for assets placed into service. This is if you buy a fixed asset like equipment, furniture, usually that have to be depreciated over the life of the asset, 5 years, 7 years, 15 years. That is now 100% expensing. For federal purposes, states have different rules. So you're going to have a difference between your federal and state where you're picking up more income at the state level. And you have a timing difference across different years. There's changes to the GILTI regime. They have renamed it Net CFC Tested Income. The Act, which renames GILTI to Net CFC Tested Income, limits the deduction that may be allocated to income in Net CFC Tested Income category the deduction for net CFC tested income itself, as well as taxes imposed on that income, any other deductions allocated to net CFC tested income. Further, no amount of interest expense of R&E expense may be allocated to this category. So changes to the international tax regime if you have foreign entities, controlled entities overseas. 1% floor for deductions for corporate charities. The deduction can't exceed 10% for corporations. For personal, that's 60% of AGI. But they added a 1% floor, so similar to individuals where you can't write off charity above 0.5% of your income. You can't write off charity for corporations until they've donated more than 1% of their net income for the year. Section 179 expensing has been increased to $2.5 million. 100% depreciation election for real property. So the Act adds Code Section 168N. This provision allows a taxpayer to elect a 100% deduction for qualified property placed into service. This is to be used for qualified QPP, qualified production property. So if you buy a non-residential building and it's used, the portion of it that's used for qualified production activity, which is manufacturing, that doesn't include food, and there's a few things that go into the specifics of what qualified manufacturing is, but generally, if you are buying a non-residential building, which would normally have to be depreciated over 39 and a half years, that is eligible to be expensed 100%. Put another way, if you buy a $10 million building and say 10% of it is office space, you can write off $9 million in 1 year under this new rule, as long as it's placed in service before January 1st, 2031. And it's the first time it's being used for manufacturing. That is a massive tax write-off to the likes I've never seen before. A huge opportunity. And if the business is not used for manufacturing within a 10-year period of placing into service, there's a 10-year recapture. So if you stop manufacturing, you have to recapture that $9 million as income if you do not continue to use it for 10 years after taking that deduction. The ordering rules have changed for 163J, and it reverts from being earnings before interest and tax to earnings before interest, tax, and depreciation and amortization. And it excludes subpart F and GILTI in section 78 in 163J. 163J is the limitation that places how much interest expense a business can write off. Expansion of qualified small business stock, QSBS. This is a big one for C Corp owners and owners of founders and startup companies. Under the Act, the gain on applicable percentage, 50% for stock held for 3 years, 75% of the gain can be excluded if the stock's held for 4 years, 100% the stock is held for 5 years, is totally excluded under QSBS. The total assets that a company can hold used to be 50 million in order to get that stock 100% gain exclusion. So if you got small business stock in a company before it had 50 million assets and you sold that stock, the gain can be 100% excluded if you held it for a certain amount of time. Now, if the company is below $75 million, you still get that gain exclusion under the expanded QSBS deduction. Enhancement of advanced manufacturing credit. The section increases the credit to 35% of property placed in service. After 2025, it was 25%. This is the advanced manufacturing investment credit. Increased information reporting threshold for certain payees. Normally, you have to issue a 1099 miscellaneous or NEC when you pay a contractor more than $600. That increases to $2,000 starting in 2026. 1099K was going to go down to $600. So if you get paid through a merchant like PayPal or some other payment processing form, now it's $20,000 that when they issue the 1099K, or 200 transactions is when you'll get that 1099K issued, like Venmo and platforms like that. Treatment of capital gains from certain farmland. The Act allows sellers of qualified farmland to elect to pay capital gains tax resulting from the sale over 4 equal installments. For all our farmers out there, that's a nice little break. Section 162M control groups. So public companies are not allowed to deduct salaries paid to executives over $1 million. This new law makes it more strict, where companies that are controlled by the public company, like single member LLCs and other groups that are majority controlled by the company, those executives and the top 5 compensated employees after executives cannot write off salaries over $1 million. This is really interesting. There's a part of this law that clarifies part of the old law that starting in 2026, employer provided meals. So if tax season, everyone's working late in the office, you buy the owner of the company buys everybody food to keep them working, keep them motivated and working through a late night. This way they don't have to get up, go out, get food, and now they're working later because they had to stop and get food. If food is brought in and provided by the employer, 0% of that is now deducted starting 2026. Very interesting. Regular meals with clients are 50% deductible, but if you're providing your employees meals, it's 0% deductible starting 2026. Curious to see if they'll change that. That's an interesting one to make 0%. Limit on business losses has been made permanent, so you can't write off more than $250,000 if you're single, or $500,000 from an LLC, partnership, or an S corporation. It limits those losses per year. Enforcement provisions were related to COVID, employee retention credits, ERTC. Man, us accountants, we've been waiting for this one. The amount of fraud firms that popped up getting everyone this ERTC credit who are not entitled to it. They knew what they were doing, and now the government is going after them. The IRS has warned repeatedly against ERC marketers that have aggressively advertised their service to help people. On September 14, 2023, the IRS paused the processing of new ERC claims due to the increased improper claims submitted through the use of ERC mills. On August 8, 2024, the IRS announced that it processed ERC claims filed between September 14, 2023 and January 31st, 2024. The Act provides several provisions covering the enforcement by the IRS of fraudulent ERC claims. First, it imposes penalties on any COVID ERTC promoter who aids or advertises COVID ERTC documents and fails to meet due diligence requirements similar to those under Code Section 6695G when determining eligibility for or one of any credit advance payment under Code Section 3134. The promoter will face a $1,000 penalty per failure per document. The penalty applies only to documents used in connection with tax return claims. So they're clearly going after these firms that were processing these ERTC claims fictitiously when they knew what they were putting through did not meet the requirements for the employer to get this ERTC claim. The Act defines COVID ERTC promoter as any person that provides aid, assistance, or advice regarding COVID ERTC documents, and their fee is based on the amount of credit work is more than. So if they're getting a percentage, if they're getting paid only when the refund is issued, that was the typical deal. They'd keep a third of the refund, and the work is more than 20% of the company's gross income. So if the ERTC firm has more than 20% of its revenue coming from ERTC claims, COVID ERTC work is more than 50% of gross revenue, and both ERTC work is more than 20% of gross revenue, and it exceeds $500K. So they are going after these firms big time. The Act goes on to define COVID ERTC document as any return, affidavit, claim, or document related to credit or advance payment. The Act limits the availability of new ERTC credits or refunds after the enactment date unless the claim was filed before February 1st, 2024. So they have shut down ERTC claims from being eligible. It further extends the limitation on the period to assess any amount of adjustment related to ERTC claims to be 6 years. That's usually the greater statute of limitations when it comes to fraud or criminal intent. So that there is a very from 6 years out from here, they're going to be going after those fictitious ERTC claims, and specifically the firms that were involved in pushing this fictitiously just to profit off 33% of these refunds that were issued. So very interesting to see what happens there. No tax on tips. The new law provides a temporary deduction for years 2025 through, I believe 2028. The deduction on tips is up to $25,000 for those making under $150,000 single and $300,000 married. Tips must be properly reported on IRS approved forms. So they specifically don't say W-2, so you may be getting a separate form from your employer showing tips amounts. And this is only for industries customary to tips. So if you're an engineer, let's say, you're probably not getting a tip. This is specific to industries that get tips. And this deduction is available to those who don't itemize. They can get this up to $25,000 of tips tax-free. There is still FICA required on that. So your tips are subject to 7.5% Social Security and Medicare tax. And this is effective through 2028. Expansion of paid family and medical leave credit. The act allows an employer to instead choose a credit from premiums paid to employees or premiums paid to the insurance, take it as a credit, or they can deduct the cost of actually paying for the premiums or the leave if an employee takes leave. So you got to optimize if you're the employer and you're doing your business taxes between the credit or the wage deduction. No tax on overtime. The creation of a new temporary deduction for overtime pay. Taxpayers can deduct up to $12,500 of overtime compensation, $25,000 for joint filers. $25,000 for joint filers of overtime is tax-free. The deduction phases out for those that make $150,000 single and $300,000 married. So $12,500 single or $25,000 married, you can deduct in overtime tax-free. This is for jobs specific that get overtime. These are non-exempt, non-salaried employees under Section 7 of FLSA. So if you're a salaried employee, you cannot get this. The overtime will be reported on your W-2. So if you make overtime, the amount that should be taxed, the amount of overtime pay will be stated on your W-2. And the no tax on tips will probably be a separate form. What I found interesting here, and I'm not exactly sure how this is going to work, overtime can be reported on 1099s according to this. Now, I don't understand how that works. I mean, 1099 pay is 1099 pay. There's no hours or overtime associated with 1099, but they put that on here. So curious to see how that looks or what the implementation is. We will probably get more IRS and Treasury regulations talking about that. Enhancement of employer-provided child care credit. Employers to claim effective 2026, the Act increases the employer-provided child care credit, increase in credit percentage for qualified child care expenditures from 25% to 40% and 50% for small businesses. The maximum credit is $500,000 and $600,000 for businesses and small businesses, respectively. Employee exclusion for employer payments to student loans. This is still in effect, and it's been made permanent. Up to $5,250 a year can be given to employees to tax-free to pay for their school or their student loans. That's a nice little fringe benefit to offer employees that all employers can offer. It just has to be offered to every employee. The dependent care, the amount employers can give tax-free dollars for qualified dependent care is an increase from $5,000 to $7,500. The exclusion for bicycle commuting reimbursement, so $20 tax-free a month, was supposed to come back in 2026. That has been permanently removed. Termination of cost recovery for energy property. Energy property can no longer be depreciated over 5 years. You have to depreciate it over a longer time horizon. Wind credits have been removed after 2027. And now we get into a lot of the energy credits. The energy efficient credit for energy efficient improvements to your home after 2025 goes away. That's windows, doors, things like that. You get a $1,200 credit. 2025 is the last year to claim those. The residential energy credit for things like solar it's also going away after 2025. So if you were thinking about making energy efficient improvements to your home, do it in 2025, not in 2026, because these credits go away. If you're thinking about buying a clean energy vehicle, those credits go away in September 30th, 2025. So that concludes the One Big Beautiful Bill. We will get more clarification on a lot of these things, and keep in mind this bill is several hundred pages, and this is me reading a 45-page summary. So there's probably more in the fine print, but this was meant to be a comprehensive overview of some of the changes. Thanks, and follow along for more.